Bitcoin Bob got what he deserved. All right, friends, this is Ernie here, Trader of Options, and we're here to talk about the zero DTE inversion of risk strategy. What is that? Well, first of all, what is zero DTE? It's a popular setup. I mean, it's a generic term for a 0 days to expiration, but it's specifically referring to the options on the S&P index, like the SPX, or the futures, like the E-mini S&P, or the SPY ETF. And the reason why it's so popular is that there are 3 expirations per week, unlike any other stock or index out there that might have weeklies or monthlies. They have 3 per week, which means that there's great opportunity to profit, and particularly for people who are into day trading. There's a definitive edge, unlike most day trading. Problem is that most people, and it's becoming very popular, by the way, this idea of trading options on the very last day of expiration on the S&P. At first, you would think, oh, it must be because premium on those options contracts is decaying at a hugely fast rate, and I can take advantage of just that, right? Well, that is kind of like the idea, but that's not what most people do. Oh, I can put on a risk-defined option strategy and have something that has contained risk and lots of upside, right? Yeah, but except that that's what most people, they don't do that. They do the exact opposite. In fact, people who are trading the zero DTE event, the thrice weekly event, seem to be doing everything in their power to put on as much risk as possible with as little profit as possible. And you say, whoa, Ernie, how do they do that? Well, I'll tell you. The general strategy, and there are some people out there that are very popular, have become popular, leaders in this. And I'm not going to name any names, but there's a woman. There are actually 2 women that are into this. There's another guy. There's a couple of guys. One that just takes it to an extreme, and others that are a little bit more reserved. And they've got data and blah, 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 blah. But their general strategy is this. Put on an iron condor early in the day with extremely high probability wings. In other words, the put spread and the call credit spread, make them like 5 or 6 delta, which is a 95% probability trade. They figure, okay, well, the S&P is fairly volatile, and during the day has a nice range. We can get some good premium early on. We put on this wide iron condor, and if we select it correctly, we can perhaps capture it and go all the way to expiration by the end of the day, which hardly ever happens because they always miscalculate, or they're taking the kind of risk that is just completely mind-blowing. When you put on a 95% probability trade, what you're doing is you're saying, hey, look, I'm willing to make this much for this much risk. Now, how often does an iron condor or their position get challenged? Probably not that often. Maybe 1 out of 8 times, something like that. Maybe 1 out of 6 times, which is still quite a lot. So if they were to hold it, though, right until expiration, at least the odds are saying that only 1 out of 10 or 12 times will they actually get challenged and then get the maximum loss. Here's the problem. The maximum loss is so huge that even if they win, say, 4, 5, 8 times in a row, that one loss can wipe out everything. And who's to say that you can't get 2 or 3 of these losses in a row? It seems unlikely, but it happens. Happens a lot. And with that, you could easily wipe out an account very, very quickly. And particularly with most of these people that are trading this strategy, there's more to the strategy, by the way. They've come up with the brilliant idea of setting a stop that is 3 times the credit that you receive, thinking that that will contain their risk. But it doesn't, because then it just essentially takes their 95% probability trade and turns it into a 40% probability trade, or maybe a 50 or 60% tops. So now they're going to be hitting that stop much more often because the probability of touching is very high. And they're going to lose on all these trades. Every once in a while, they'll bring it to fruition to make their measly scraps. So at first I thought, hey, this was a good idea. We can put on these high probability trades. We can just sort of chip away at our profits, and then things are good. Until you start running into those days where it's not so good. Market goes against you. You figured wrong about where to actually put the wings of this iron condor. Plus the fact that most people are trading the SPX or the SPY, and you really need a $25,000 account because you're going to be managing this trade. You're going to be doing frequent management, which means several trades within the same day, which means that if you do not have a $25,000 account, you're going to run very, very quickly into the pattern day trader rule. And if you do not manage that well, your account is going to get locked up for 90 days. Now, there are ways around this. One is you can have $25,000, but most people, most day traders, they don't want to put at risk their $25,000 account, because if you do, with this type of strategy, and you run into multiple losers, you could very, very quickly wipe out that account. So what most people do is they say, well, I'm going to set my risk limits at, say, 10% of my total account size. And so they'll say, I'm going to do it with a $5,000 account. But then that limits their opportunities when they can actually take this trade. They'd only be able to do it a couple times a week. Otherwise, if they did it 3 after 5 rolling days, they would be shit out of luck. They wouldn't be able to trade anymore until at least some of those trades came off of the broker's book so that you don't violate the pattern day trader rule. Now, there is a way around this. One way is don't do options on the SPX or the SPY. Do it on futures, the E-mini S&P. There is 0 pattern day trader rule, and you can trade as much as you want. All right, so let's get to the inversion of risk part. For me, right now, that strategy is a no-go. It is only a matter of time. I don't care if you've won 20 times in a row. It's only a matter of time that you wipe out your last 6 or 7 trades. And then it's only a matter of time where you do it 2, 3, 4 times in a row, rather than the tiny little wins that you're getting with your 95% probability trade, which really isn't 95% probability, which is really more like 50 or 60% probability because you put a stop in there. Who puts stops in an options strategy? That's the whole idea behind options, is that they give you defined risk. So my idea is to do a complete inversion of risk. Why not only put on trades that have the exact opposite, maybe 1x risk to 10 times profit? But then you'll say, but Ernie, the chance of you ending up at the end of the day with that 10 times is very, very small. I say, yeah, that's true. However, the probability of touch during that day, or the average movement within that day says that I will probably climb that T0 line, the actual profit and loss line, at least some way during that day, earlier on in that day, where I can conceivably return 50, 100, 150% of the risk that I take on. And if it does move all the way into the area where I choose, the profitable area, what I call the profit tent, what most people call the profit tent of that strategy, I chance making 10 times the risk that I put on. 10 times. We had a trade yesterday that worked out almost that way. But I've demonstrated in the groups, in some of the groups that I belong to, how I've been able to pick that 10x spot fairly regularly with our analytical methods using volume profile and linear regression and the normal implied volatility. We can pretty much, if we can get the direction right, we can hit that 10x profitable area on a fairly regular basis. But we don't really even have to, because that's just the bonus. If we can come in and just make 50, 100, 150% on our money, what's wrong with that? And we can do it on a regular basis. So the inversion is that we can still make those tiny little profits just like the other zero DTE guys. We can make them more often. Plus, we can make the big kahuna profit that they can never make. As a matter of fact, what they substitute for our big kahuna is a big babutska. I don't know, what's the other word, the opposite of kahuna? The big buckets award. So that's the inversion. We can regularly make small little profits and then every once in a while make a huge profit, as opposed to regularly making small little profits and then every once in a while making a huge loss. Which would you rather do? That's I think that's a rhetorical question. I mean, it's a no-brainer. Of course, you'd rather do the inversion method. Plus, it's just far more enjoyable a way to trade. You don't feel stressed ever because you're not worried about the big risk. You're not worried about the probability of touch. You're not worried that you're going to get stopped out, because you never get stopped out, ever. The only thing you have to worry about is the tiny, minuscule risk that you put on. So that is my inversion of risk strategy using zero DTE. Now, I'm not going into all the particulars because the particulars are proprietary to our service. However, for the next few weeks, I'm going to be demonstrating this like I did yesterday, where we had two separate accounts, one where we made 140% on our profit and another where we made 140% on our risk, and another where we made 200% on our risk. And we were heading towards that 10 times, but it never really got there. But that's not a big deal. I don't care. I just made, on average, 175% on my money for the day. And so we'll be doing this tomorrow. We'll be doing it Monday, Wednesday, and Friday going forward for the next few weeks. If you're interested in signing up, the link will be below. Let's see, we got some comments. Please explain the exact trade you are talking about. Why would I do that? Do you want me to take and just give everything away? I mean, we can use butterflies, but we don't. We can use credit spreads. It's mostly credit spreads that we can use. We could also use just a simple long strategy. You have to also remember that I have a lot more flexibility in terms of the amount of profit, potential profit that I can gather with futures as opposed to the SPX, because futures trade 24 hours a day. So I don't have to start my trade at 9:30, although I can for most purposes. I can start my trade at 8 o'clock in the morning, 7 o'clock in the morning, 3 in the morning if I want to, where there is a lot more credit available as well. But that's not really part of the strategy. I'm just saying I have that option. Also, I have, because of that 24-hour nature, the continuity of the futures contract, my ability to analyze the market is superior in every way compared to the SPX or the SPY. So Mario is saying, what you are describing is just the opposite of the strategy I mentioned originally. And you're right. It absolutely is. Because after a few times, it was unworkable. And so the small winners, right. Then the potential for one massive loser, you are saying, will happen often. Yes, it will happen often. And it only has to happen once. But when it happens twice or 3 times in a row, well, let's say it happens once, then you have a couple more winners, then it happens again, and now you've lost maybe 2 months' worth of trades, you're not going to be happy. On top of that, you're going to be sweating your trade the entire time. Well, and were you saying small losers, then the potential for some winners, massive winners? No, it's actually, you have some small losers, but most of them are small wins because of the probability of touch. So you could decide that, look, I could take this trade only for the next couple of hours. I'm out, and just decide to take the 100% or 150% gain. Sometimes you have a massive trending day, and you can detect that, and then it makes sense just to hold on to the trade and allow price to move right into your profit tent for that massive win. Those become obvious when you start looking at our analytical methods. So if you see a trending day, that's when you hold on for the massive win. And even if it doesn't get to a massive win, sometimes it can get to a 200 or 250, 300% winner without ever actually reaching that 10x winner. So all around, it's good. So they're not, and every once in a while you guess wrong and you have a very, very small loss. So people want to know the strategies that I'm using. I'm telling you I'm using credit spreads. That's what I'm using. How often do I do my trades? 3 times a week. That's right. Monday, Wednesday, and Friday. So Stuart's saying that the commissions are higher on futures, and that is true. But when you look at the amount of premium that you get with respect to the risk that you're taking, the premiums aren't that much higher. They're only about 3 to 4% higher than other commissions. So this idea that premiums are too high on futures is absolutely ridiculous, especially when you consider the benefits that you're getting from trading the futures in terms of no pattern day trader rule allowing you to trade in much smaller accounts, and also the continuity of price action so that you can have much more accurate analytics, as well as the ability to be able to put the trade on anytime that you want, from 6 o'clock the previous evening all the way through right up through to the current time. So are you saying that paying 3% more isn't worth all of those benefits? I think it is. So there is no comparison. I don't know what you're talking about. Trade in 25-cent lots. That's not true. If what you're saying is that that the granularity of the profit is not in 25-cent lots, but it's actually in $12.50 lots, is annoying. I don't know what to say to you. Okay, so it's annoying. So I make more money more often with less risk, and I have to put up with this minor annoyance. It doesn't make any sense. So anyways, I don't see any questions here that are really challenging this. I mean, I've demonstrated this many times in other places, and it's super simple, super pleasurable, because you're not really worrying about ever hitting your stops, or if you're not putting on stops, hitting or challenging the edge of your iron condor, which is a huge cliff. So anyways, that's zero DTE and the inversion of risk. And if you would like to learn more, now I'm not, my service has alerts, but that's not what my service is about. My service is about coaching and mentoring. So there is a small upfront price that you pay, and then a monthly fee for the alerts. And you'll find that that's the way all my services are geared. I am focused on teaching you actually how to trade, and I am there to support you all day. As a matter of fact, every one of my clients gets my personal phone number, which I answer immediately. And we provide coaching sessions multiple times a week and a review at the end of the week. So it's not just $60. I just want to be clear. It's not just $60 per month. That is for the alerts. But there is a one-time upfront fee. It's a very small fee for what you get. Quite frankly, that fee is probably what most other people are charging that per month. I charge that one time. Okay, any other questions? I guess that's about it. All right, I want to thank you all for showing up. And like I said, I'll be on air probably around 12 or 1 o'clock Eastern time every day, well, on Monday, Wednesday, and Friday, going over the trade that we made earlier that day or are about to make, because I never really know when I'm going to put on that trade. Typically, I like to put it on early in the day or even before the market opens. That gives us our best opportunity. Now, assignment risk, never worried about that. The assignment risk almost always cancels out. And even if it does, even if you do get assigned a futures contract, most brokers will take care of that for you in the back office. But it's really never more than just removing the futures or just letting go of the futures contract as soon as it's assigned. And if it is going to be assigned, that happens within the first 5 minutes after the market is closed. So assignment risk really isn't an issue. It's more just of a management thing. And like I said, in most cases, your trade will just cancel out and your broker will never assign you. So there you go. All right. Thank you very much. And we'll see you tomorrow. I'll be on Tuesdays and Thursdays doing a similar, I'll get a little bit more in depth in some of the strategies and methodologies that we use. But I'll also be talking about our other services besides zero DTE. There's also our 3D options service and our natural resource investing service that we call the Advisor Newsletter. All right, take care.